Well, if you're on the line, welcome. Welcome to the Truck Loggers Association webinar on the proposed federal tax changes. I trust everyone can see the screen, have got their software working, and are able to listen to us via the dial-in number. What we're going to do today is I'll say a few brief words, then we'll immediately pass it over to M&P, who will run us through the webinar. So again, I'd like to welcome everyone to the call. I'd like to say thank you to M&P, a TLA member, for putting this webinar together. The TLA is hosting this event because this information is important to our members who run small businesses. At the end of the call, I'll say a few words on our advocacy effort, but without further delay, I would like to pass over the mic to Chris Duncan and Jamie Kungle of M&P. Chris, it's all yours.
Thanks, David. This is the agenda for the webinar today. We're going to go over an overview of the webinar itself, then we're going to go through the background of how we got here, the current rules. Then we're going to jump into the federal government's tax proposals that were released in July, including income sprinkling, passive investment income changes, and converting income into capital gains. At the end, we're going to have some time for questions and answers. If you notice, there's your Ask a Question box on the webinar, and we will address 2 or 3 of the questions that come up during the webinar. Any of the other questions that we aren't able to have time to answer today, we will answer them, and the TLA will be posting this to their website later on. And at the end, David will wrap us up. This is just some small print. Basically, it's just saying this is educational overviews only. Don't make any business decisions based on it. Make sure you talk to a professional first of all. So how did we get here? Recent history. So part of the Liberal government's election platform was based on endeavoring to cancel income splitting and other tax breaks and benefits for the wealthy, as they put it, while not ending pension splitting and whatnot for seniors. Other notable commitments that the Liberal government made was that they will increase the marginal tax rate on Canada's top 1% so that they could cut taxes for the middle class. They also commented that we will conduct a review of all tax expenditures to target tax loopholes that particularly benefit Canada's top 1%. So since winning the election, we've seen a few changes. Big ones would be in 2015, the Liberal Party committed to reducing the small business tax rate from 11% to 9%. At this time, the federal rate's only been reduced to 10.5%. In 2016, the federal government increased the tax rate by 4% for individuals earning income in excess of $200,000. And in budget 2016, new rules were introduced concerning the multiplication of the small business deduction. Some more changes. In both 2016 and 2017, the government's increased funding on CRA. The Liberal government's investing about $1 billion over the next 6 years, with the view to recover an additional $5 billion in additional tax revenues. In budget 2017, the government also signaled its intention to address specific tax planning strategies involving the use of private corporations. So on July 18, 2017, the Department of Finance released some draft legislation and a paper for consultation focusing on these changes. 3 of the key tax planning areas for Canadian-controlled private corporations, that being income sprinkling, which was included in the draft legislation, holding passive investments inside private corporation, converting income into capital gains, which was included in the draft legislation. The proposals reflect some of the most significant changes that we've seen to taxation on private corps in the last 45 years. So I'm going to pass it on now to Jamie Kungle, our regional tax leader, and he's going to talk about the specific changes.
Thanks, Chris. I'd also like to thank the TLA just for this opportunity to speak to you in regards to these changes. As I go through these various slides, please note that I'm going to be talking about these changes in regards to how they impact you as small business owners. and I'm going to be talking about them at a kind of a 30,000-foot level. These are very technical proposals that they've brought forward, which professionals are still trying to fully wrap their heads around and understand the full implications of these changes. And as Chris had mentioned, these are the most significant changes we've seen in the taxation of private companies, probably in the last 45 years. And these changes are potentially going to impact things that we have been doing in the past. In addition, they're going to impact the way small business owners plan for retirement. Now, as Chris had also mentioned, these changes, proposed changes, are only proposed at this stage. We've seen draft legislation on 2 of the proposals, and we've seen no legislation on the 3rd. So at this point in time, decisions should not be made based on these draft legislation. The hope is we will see some changes as we progress along in this consultation period. So do not make any decisions on what you're seeing and hearing right now. It was interesting because when these proposals were announced, they were announced in a very, very political manner. If you heard the press conference, they kept on referring to fairness and having a fair tax system and ensuring small business owners pay their fair share of taxes. They alluded to the fact that small business owners were taking advantage of tax loopholes that maybe were not intended to be utilized. And it's unfortunate because it's created a bit of a conflict between small business owners and employees. And this was probably done potentially for political purposes. With that aside, I'm going to jump into the changes, and the first one is our sprinkling income through the use of a private company. Sprinkling income is a term that's used when businesses are structured in such a way that we remunerate the family in a way of paying dividends to a lower income family member while keeping income out of a higher income family member's taxable income. And through doing this, we're able to create kind of absolute tax savings. And as there are more and more family members in which you can do this with, there's more and more tax savings that are available. In addition, income splitting, you're able to take advantage of income splitting when you get to the point where you're actually looking at selling the shares of your company. And one of the benefits that's out there to small business owners is something that's known as the lifetime capital gains exemption. And that's a $830,000 exemption on the sale of shares of a private company that's involved in an active business. And finance was concerned that through the multiplication of these exemptions, business owners were taking advantage of the taxation system. So the government's concerns, and you'll hear this through a lot of the presentation, it was unfair. It's not fair to the employees that business owners are able to take advantage of income splitting when employees are not. There are rules which prohibit some forms of income splitting, but they only captured when you were trying to split income with minor children. They didn't capture paying out income or dividends to spouses or adult children. And as the amount of income that is earned increases, and if you have a larger family, you're able to multiply those tax savings. And the government didn't like that. The business owners' concerns are certainly different. These proposals, as the government has announced, are not just going to impact the wealthy. They're going to impact all small business owners. So the government is not just going after that 1%. They are going after a broad base of taxpayers. And the government draws parallels between employees and entrepreneurs. And business owners feel that that's not accurate. There's an unfair, or there's a lack of understanding of the two groups. employees, when they get a job, they don't have to go out and get a mortgage or take out debt to earn income. Entrepreneurs, on the other hand, if they're going to start a business, they likely have to go to the bank, incur debt, and then start hiring employees and so on. Employees do not have to do that. So there's a real difference between these two groups, and business owners feel that you shouldn't be treating them exactly the same. And then, in addition, these changes are going to create a significant amount of uncertainty. As you'll see later on when we get into the actual proposals, they're very vague, and it's going to be hard for advisors to actually provide good advice to their clients on what they should be doing. So this is a very simple example of how you would structure a business to take advantage of income splitting. You have the operating company at the bottom, and that's where you're generating all of your profits. And then the operating company is owned by the operator, his spouse, and their children. And each of those individuals hold different classes of shares. And as a result of holding different classes of shares, we can pick and choose who we want to pay dividends to, so that we can move income into a lower income person's hands and keep it out of a higher income person's hands. This slide is a numerical example of the benefits of income splitting. As you'll see on the column on the left, you have an operator who's earning a $200,000 salary from his operating company. He pays taxes of approximately $70,000. But the family needs another $160,000 to live off of. So we're going to pay a dividend to move that $160,000 into the family's hands. And what we do is we sprinkle our dividends between the spouse and the children. They each receive a $40,000 dividend. And as you can see, they pay next to no tax as a result of the dividend tax credit and the personal exemptions. So they each pay about $1,000 worth of tax on a $40,000 dividend. So we've removed $360,000 from the company and only pay $73,000 in tax. If that owner-operator were to have paid that $160,000 dividend into their personal hands, they would have had a tax bill of $144,000. So through splitting income, we've reduced the family's tax burden by $70,000. So before we get into the proposals, where we sit right now is you cannot split income with minors if they are earning either dividends, business income, or capital gains in regards to a business that they are related to. So if you had a child who is 10 years old and you tried to pay a dividend to them of $40,000, let's say, they would pay tax at the highest marginal tax bracket. So there'd be no benefit whatsoever to paying a dividend to a minor child. But that's as far as those income splitting rules went. And now finance is proposing to change those. And they're going to change them, or proposing to change them, in this fashion. That the tax on split income rules, which was our kiddie tax rules, will now apply to all Canadian residents, regardless of their age, who receive income from a related business, unless what they receive is reasonable. And then in addition, they have expanded the definition of the income that gets caught by these split income rules. That now, in addition to capturing dividends, business income, and capital gains to a related party, it also includes interest income, income or gains from the disposition of property, doesn't need to be to a related party anymore, income from the conferral of conferred benefits, and income that's earned on income that you've already received. Now, the problem with this legislation is that it talks about the consideration being reasonable for, effectively the contributions that the individual has made. And they have provided us with the factors that they're going to look at when determining whether or not the income is reasonable or unreasonable. They're going to look at the labor contributions, So whether or not the individual is actively working in the business, they're going to be looking at whether or not that individual has contributed capital to the company, whether or not they are taking on risks, and in addition, they'll look at kind of previous returns and remunerations. So it's very, very vague in the factors that they'll be looking at. And, you know, should CRA come in and audit an individual and try to make a determination of whether or not the consideration is reasonable for the services they're providing, it's going to be up to the CRA auditor to make that determination. And they're likely not going to be very generous when they're thinking of whether or not something is reasonable or unreasonable. And if they determine that an amount is unreasonable, the tax on split income rules will apply. And what that'll mean is that that individual who received that unreasonable income will now pay tax on it at their highest marginal tax rate. So there'll effectively be no benefit to splitting income with a family member if it is considered unreasonable. So what are some tax planning strategies to consider in light of what they've proposed? Well, first of all, these rules are not going to be effective until the 2018 taxation year. So for 2017, we still have free rein to do what we want. So what you're going to want to consider doing is look at who you can split income with right now through dividends and possibly pay larger dividends to, you know, a spouse and adult children to fully utilize their lower tax brackets. Because once we're into 2018, we're no longer going to be able to do that. It'll fully be based, the taxation will be based on whether or not it is reasonable for the services and the contributions that they have made. And then in 2018, we're going to want to look and evaluate you know, what those family members are doing and document that so that we can put together reasonable you know, reasonable explanation to CRA should they come and ask on why this compensation is reasonable. The other thing that we might consider doing is we might consider looking at additional remuneration strategies. Historically, we've moved away from remunerating spouses and children through salaries because there was a reasonableness test on the salaries that were paid to those individuals. But salaries are not included in the tax on split income or on the split income. If CRA is going to challenge a salary and say that it's unreasonable, what they do is they disallow the deduction to the company. And if a company is only paying an effective tax rate of 13%, there is going to be a significant benefit to paying the salary and taking your risks on paying salaries as opposed to paying dividends. Because your downside to paying a salary is a disallowed deduction, which is going to cost you 13% of that deduction. And then finance also was obviously not a fan of the planning that was done to proliferate the multiplications of capital gains exemptions. So they have proposed changes to the capital gains exemptions as well. And they're looking at limiting the ability to claim your capital gains exemptions when a business is sold. And what they're going to do is they're not going to allow minors to claim their capital gains exemptions in 2018 and going forward on any sale period. Under the current rules, minors can still claim their lifetime capital gains exemption if the business is being sold to an unrelated party. In addition, adults will now no longer be able to claim their capital gains exemption on dispositions to the extent that the gain on the sale of the shares was accrued before the person turned 18. So any gain that was accrued while they're a minor, you'll no longer be able to shelter with your capital gains exemption. In addition, if shares are held in a trust, you will not be able to shelter the gain that's accrued to the trust. And finally, there's going to be a reasonableness test that's brought in as well. So if the capital gain would be considered unreasonable for the contributions that that individual has made to the business, they will no longer be able to use their capital gains exemption on the gain that they realize when the shares are sold. Now, there are some transitional rules in regards to the taking away of the capital gains exemption. And in 2018, eligible taxpayers will be able to crystallize their capital gains exemption to ensure that they are able to increase the cost base of their shares up to at least 2018. Eligible taxpayers will include individuals and personal trusts. So if someone knows that they're going to be selling their business in, say, 3 years, and there are adult children who hold shares of the company with an unrealized gain on those shares, in 2018, you would trigger a portion of that gain, which would allow them to utilize their capital gains exemption. So finance is somewhat grandfathering, providing some grandfathering on the exemption and not fully taking it away. As far as planning strategies to consider, one of the things that may make sense is actually looking to crystallize your capital gains exemption in 2017 instead of 2018 for those individuals who could make the election. There's a couple of reasons for doing that. One is it's anticipated that CRA is going to be auditing those 2018 transactions. There are penalties if you if you claim too much capital gains exemption and you didn't have the unrealized gain there. CRA will penalize you. So the thought is if you do it in 2017, it may draw less scrutiny from CRA. And then if you can actually enter in, if you are planning on selling your business, if you can complete that sale in 2017 as opposed to 2018, that would be a good thing to do. But the idea is that you lock in your accrued capital gains, whether it be in 2017 or in 2018. Now we're going to get on to the second proposed change. And this is the taxation of passive investment income inside private companies. And this is the one where there is no draft legislation that's been provided by Finance. So we are just basing, everyone's basing their comments on what Finance has said they want to do, but they haven't actually said how they're going to do it. But before we get into the actual changes, there's a couple numerical examples I want to go through to kind of show where Finance is coming from in what sense. So our taxation system is based on something that's known as integration, where you'd be indifferent if you're earning your income as an employee or if you are incorporated. So on the far right column, we have an employee who earns $500,000. They will pay tax at the rate of, let's say, 49%. So they'll pay approximately $245,000 in taxes, which will give them $255,000 to invest as they see fit. If that money is earned in a corporation, we're going to pay tax at a rate of 13%, assuming it's active business income. So the corporate tax that you pay is only $65,000. That will leave the company with $435,000 to invest. So the company has more capital to invest than an individual does. When the corporation pays a dividend out to its shareholder to put that cash into their personal pocket, they will pay tax at a rate of, let's say, 41%. So they'll pay about $180,000 in tax, which will give them $255,000 in their pocket, the exact same amount the employee had. The only difference is the corporation had $435,000 to invest, while the individual had $255,000 to invest. So the government feels that there's an unfair advantage to the corporation because they have $180,000 more to invest. Now, if we take that a step farther, we look at how passive income is actually taxed. And this is assuming that it's, say, interest income. An employee would have, let's say, $500,000 of investment income. They'll pay taxes of $245,000, so they have $255,000 in their pocket. An effective tax rate of 49%. A corporation, on the other hand, they earn $500,000 of passive income. They're going to pay tax at 50%. So they will have $250,000 left. Now, when the company distributes that $250,000 to the shareholder, they're going to actually get a refund. The company will receive a refund for some of the taxes it previously paid. So the company can actually pay a dividend of, let's say, $400,000. The shareholder will then pay tax on that, now let's say at a rate of 41%, so there's $164,000 in personal taxes, which will leave the individual with $236,000 in their pocket. So the corporation is actually, if you invest through a corporation, you're actually slightly worse off than if you invest personally, but you did have more money to invest. In theory, if our system of integration worked perfectly, those effective rates would be exactly the same. Now, one of the main reasons why corporations or businesses are operated through a corporation is the ability to take advantage of that tax deferral. And there's a lot of reasons why that tax deferral is beneficial to a business. It's going to allow them to pay down debt significantly faster than if that business operated in their personal name. It's going to allow them to save for business expansion. It's going to allow them to save for unforeseen contingencies, for a slowdown in the economy. In addition, it's going to allow them to save for retirement. So business owners often look to incorporate their business so that they can take advantage of that tax deferral. But it's only a tax deferral. It's not a tax savings. Finance is of the opinion that, this is an unfair advantage. Corporations should not have more capital to invest than an individual should, and they are proposing to make changes. Business owners, on the other hand, they feel that this tax deferral is necessary. Business owners need that to grow their business. They need it to save for a rainy day. In addition, business owners feel that you can't treat an employee and an entrepreneur the same. And it can't be based on the tax impacts alone. You have to look at the bigger picture, and you have to look at the risks that the entrepreneur is taking on, the benefits the entrepreneur is providing to the economy through employment, and you can't just base that decision on the tax impacts alone. In addition, Canadian-controlled private companies, they are singled out in these proposed changes. These changes are not going to impact public companies, and they're also not going to impact foreign-owned corporations. So finance in these changes are very specific in who they are going after. And they're treating, the small business owner, they're giving the small business owner worse treatment than public companies and foreigners. And then in addition, if these changes come in, it's going to become extremely, extremely complex from a tax and accounting perspective. This is going to be extremely difficult, and finance, I believe, is probably really struggling right now in how they actually draft legislation to do what they want it to do, which is why we don't have draft legislation today. Now, like I said, there's no draft legislation right now, but the government has proposed several different options. All of those proposed changes are going to have significant economic impacts for us all, and they're going to impact how business owners save from a retirement perspective. It may no longer make sense to save funds going forward in your corporation. You may look to move funds into RRSPs, tax-free savings accounts, individual pension plans, because the taxation on passive income is going to be at an extremely high rate. it's likely going to result in an effective tax rate when the funds are put into the business owner's hands of upwards of 70%. So if a company earns $100,000 worth of passive income, by the time that income is put into the shareholders' hands, they may only have $30,000. Now, finance has said that these changes in regards to passive investment income will be applicable on a going forward basis only. But we don't know how that's actually going to be implemented and whether or not it will, legislation will do what they are saying it should do. So there's a lot of question on how this will work. As far as things to do in regards to this planning, anything we do today is going to be completely speculative. So it doesn't make sense to do anything until we actually truly see what finance is going to put together as far as legislation is concerned. There's been a lot of pushback specifically against this change for various reasons, but this is probably the most punitive change that they are bringing in for most small business owners. And it's going to impact, it'll be factored into decision making on whether or not it makes sense to incorporate a business on a going forward basis. Now for, say, the forestry industry, I think it's still going to make absolute sense to incorporate your businesses. You're heavily capitalized, you have significant capital tied up in your equipment, significant loans to purchase equipment. Using a corporation will allow you to pay down those loans significantly faster. In addition, there's liability concerns in the forestry industry, and a corporation will provide liability protection. But in other industries, it may not, we'll have to think twice on whether or not it makes sense to incorporate businesses going forward. The final change deals with converting income into capital gains. And this is the one change where people were taking advantage of tax rates, and you could see why finance was quite offended by what people were doing. Now, to say that, they've also probably killed an ant with a sledgehammer in regards to these changes, and there is significant other impacts in regards to these changes and how they're going to impact business owners in regards to succession, and they also cause potential estate tax problems as well. But this really explains kind of the government's concerns. Capital gains are taxed at a rate of 24%. Dividends are taxed at a rate of 41%. So there's a 17 percentage point difference there. If someone was extracting a large amount of money from the corporation, let's say $1 million, if you could convert that dividend into a capital gain, you would save about $170,000. And finance was aware that this planning was going on, and they're offended by it. So they've shut the door on this type of planning. But the business owners have some concerns in regards to how they've proposed to stop this. And one of the key concerns is it's going to make it significantly more difficult to transfer a business from one generation to the next in comparison to an arm's length sale. And we'll go through an example on that and just show how much more punitive these new proposals will be. And then it's also quite troublesome for estates because you can run into situations where an estate will be subject to double tax. Previously, there was planning that could be done to get out of the double tax, and with these changes, some of that planning has been curtailed. But a quick example on the succession of a business from father to son. So Bob, who's the dad, owns a business, and let's say it's worth $1 million, and his cost base in his shares is $100. And Bob's going to sell his shares to his son, Ken, for their fair market value of $1 million. So I'm making the assumption Ken does not have a capital gains exemption available. In this situation, Ken would pay tax of about $238,000. Or sorry, Bob would pay tax of about $238,000. Ken then needs to pay Bob off. So he needs to extract $1 million after taxes to pay off Bob. So he needs to extract $1.6 million from a company to pay off the $1 million amount owing to his father. So Ken would be subject to $666,000 in taxes. So the combined taxes on the sale of this business from father to son is going to be $904,000. So on a $1 million sale, $900,000 is being paid in taxes. And this is under the new proposals. Before these proposals were brought in, the total tax liability would be $238,000. Now, with these proposals, the total tax liability is $904,000. So there is a significant penalty on this transfer of this business from father to son under these new rules. That wasn't there under the old rules, and on a sale to a third party, that's not there. So with these new rules, it's going to, given the opportunity, someone will always look to sell their business to a third party because they'll get better tax results. And with that, I'm going to pass it back to Chris to go over some frequently asked questions.
Okay, thank you very much, Jamie. So the first frequently asked question that we always get is it still beneficial to incorporate? And as Jamie mentioned earlier, in the forest industry, we believe it's still going to be beneficial to incorporate for liability reasons as well as asset protection. Also the ability to pay down business debts. So when you're financing equipment, using corporate dollars has a definite benefit in that you can pay it down significantly quicker. Other benefits that are there to keep in mind would be the access to the lifetime capital gains exemption on a future sale of the business if it's a share sale. Income splitting will still be an option as long as the amounts are considered reasonable. And alternative retirement and estate planning strategies such as individual pension plans, retirement compensation arrangements, and permanent life insurance plans are still on the table. So our recommendation is every situation is still going to be unique, and you need to talk to your accountant or your tax advisor when you're thinking about incorporating. The other question we get is it still going to be possible to split income? So income splitting through the payment of dividends or salaries is still going to be an option. It's going to be possible, but it's going to come down to that reasonable test. And as long as the amounts are considered reasonable, it's an option. The reasonableness test is going to be based on what an arm's length party would have agreed to pay to the adult individual, considering their labor contributions to the business, any capital contributions they may have made to the business, and previous returns and remuneration to that individual. Another question we're getting is, my family's shares are held in a family trust. How is that affected? So income distributed through a trust to the beneficiaries will be subject to the tax on split income rules, as though the dividend were paid directly to the individual from the operating company. The trust is going to be ineffective going forward for income splitting purposes unless it can be shown that those dividends that are being paid through the trust are reasonable, so that test is still going to apply. And further, individuals aren't going to be able to claim the lifetime capital gains exemption anymore on capital gains that were accrued while the shares were owned by the trust. Another question we're getting is, how will this affect my existing passive investments inside a corporation? So the impact on existing portfolios is still uncertain because the government has not yet released any legislation or draft legislation on this proposal. At this point, they've just proposed what they don't like and some possible options. But the government has indicated that it's intending to make some changes, and those changes will likely apply on a go-forward basis, and does not expect existing portfolios to be impacted. So our recommendation with this one is really it's a wait and hold period. wait until there's further clarification from the government and don't take any action at this point in time.